I just quickly want to preface this video by saying that this is a general review of this book, though it is slightly more for EU-based investors because I'm giving my perspective on this book. However, if you are from Asia or the States or wherever you may be from, I still think this video can be of value to you. So please watch a few minutes and then decide if this is a good video for you or not. All right, enjoy. Hi everyone, and welcome to a brand new video. Today we're taking a look at the book The Boglehead's Guide to Investing, and to basically check if this book is any good for European investors like myself. So I got the book right here. This is The Boglehead's Guide to Investing, 2nd edition. And if you didn't know, this book is basically written about John C. Bogle, which is the gentleman on the cover. And John C. Bogle is the founder of Vanguard, one of the first, or maybe the first, certainly one of the biggest ETF providers ever. So he basically kind of invented the ETF, and this book is all about passive investing. But since John C. Bogle and the authors of this book are all Americans, and a lot of it is financial advice based for Americans, I just made this video very quickly to see if it's any good for European investors. By the way, if you end up liking this video and this video does well, make sure to leave a like, because I'm currently reading The Richest Man in Babylon. I've also read Rich Dad, Poor Dad, and I've got Think and Grow Rich right here. So if this video does well, I might make one of any of those three. Leave a comment in the comment section down below if you prefer any one of those. So I think it would be best to just go through all the chapters and see if all the advice being said there is any good for European investors. And if anything in particular stands out, I'll make sure to mention it. Usually when I go through books like this, I always mark different parts that I find interesting. So anything that stands out, I'll make sure to point that out for you. So I've skipped over the introduction. Let's go right to part 1. The essentials of successful investing. Chapter 1, choosing a sound financial lifestyle. So it all starts off with 3 types of financial people. The first one is the borrowers, the second one is the consumers, and the last one is the keepers. And it's that latter one that is the interesting one, and the one that this book is going to basically be talking about, to graduate from a paycheck mentality to a net worth mentality, because it's not how much money you make necessarily, but it's about how much money you actually keep. Chapter 2 is all about starting early. So the younger you are or the earlier you start, that will all help you to grow your network exponentially. Because as this fun quote says right here, adding time to investing is like adding fertilizer to a garden. It makes everything grow. So this chapter is all about compounding interest. So as the earlier you can start, you can see your interest exponentially grow like this. And they use something called the rule of 72 for this. So the rule of 72 is very simple. To determine how many years it will take an investment to double in value, simply divide 72 by the annual rate of return. For example, an investment that returns 8% doubles every 9 years, because 72 divided by 8 equals 9. Similarly, if an investment that returns 9% doubles every 8 years, and one that returns 12% doubles every 6 years. But of course, usually the younger we are, the less money we have. However, not all is lost. Most of us don't have large sums of money to make one-time deposits when we are young. However, all is not lost. If a 25-year-old wants to have $1 million by age 65, it is quite easily achievable. Simply deposit $4,000 a year at the start of every year in a Roth IRA and get an average annual return of 8%. At the age of 65, the portfolio will be worth $1,119,124 tax-free from saving just $11 a day. However, if that same person waits until the age of 35 to begin investing $4,000 a year, the portfolio will be worth $489,383 at the age of 65. A tidy sum, but far short of $1 million. So obviously here they are talking about a Roth IRA, which is kind of like a pension saving fund. In Belgium, we have something very, very similar. So just make sure you can find something similar in your country. But the big takeaway of this is obviously the compounding interest part. It then goes on again about how keeping your money is actually more important than earning more. Obviously, both are preferable, but the keeping part is the thing that you kind of need to grow. Like you need to grow a keeper's mindset. So when you earn $1, try to save a minimum of 20 cents. Some diligent savers actually strive to save 50 cents of every dollar they earn. and then goes on and lists a couple of ways how to save more money or earn a bit more money. We're not going to go into that for now. Chapter 3 is finally about the investing part, and it's called Knowing What You Are Buying. With a quote of Warren Buffett to kick it off: only buy something that you'd be perfectly happy to hold if the market completely shut down for 10 years. And then basically goes on to list different definitions of different types of bonds and just general stocks, some treasury bonds, some other stuff. And this is all kind of American based, so personally I skipped over most of these. Just they're not all applicable to my personal case. Then in part 2 of this chapter, they go on about different types of funds as well as ETFs. A similar case here as the first part of chapter 3. Some things were not really applicable to me, but it's nice to just refresh your mind and basically to kind of know what's there, and maybe you can find something similar for you personally. Chapter 5 then goes on about inflation and how you can actually protect yourself with inflation protected bonds. And these are the first sentences of that chapter. Inflation is like a silent thief in the night that comes sight unseen and steals our valuables. Unlike the burglar who takes our visible assets, inflation is much more insidious because it steals something that we can't really see: our future buying power. It then basically goes on about what inflation is, why we have inflation, and how different rates of inflation can affect your buying power. Chapter 6 then goes on about how much do you actually need to save, with this very fun quote to kick it off. You really don't need to begin saving for retirement before you're 60. At that point, simply save 250% of your income each year and you'll be able to retire comfortably at 70. I really personally like this chapter because obviously I'm currently 24. My retirement is a long way out. So it was very nice to kind of refresh your mind and to basically see all of the tips and tricks that the book offers to start thinking about retirement early. In the beginning of this chapter, the book also offers a few factors to basically think about in order to come up with that one number that you need to hit before you retire. And these are those factors. 1, the amount we save. Obviously, the more we save, the better off we'll be. Our current age is number 2. This helps to determine how many years we have to save and invest, and how long our retirement investments will be able to work for us. Of course, the earlier we start saving and investing, the better chance we have of reaching our goals, thanks to the powerful effect of compounding over a larger number of years. The age at which we plan to retire, how many years we'll have to live off of our retirement account based on our life expectancy, whether we plan to leave an estate or if we simply want to make sure that we don't run out of money before we run out of breath, the expected rate of return on our investments, the rate of inflation over our accumulation period, whether we can expect an inheritance prior to our retirement, or other sources of income in retirement. These would include pensions, social security, reverse mortgage, and part-time work. The book then splits up in a couple of different smaller chapters talking about all of these factors and how you can kind of calculate that number that you need to hit. Chapter 7 for me was really the core of this book, and it's titled Keep It Simple. And I now would like to read a very small section of one of the first paragraphs of this chapter. How investing is different from most of life. Through education and experience, most of us come to learn and practice certain life principles that serve us well. For example, don't settle for the average, strive for the best. Listen to your gut. What you feel in your heart is usually right. If you don't know how to do something, ask. Talk to an expert or hire one and let the expert handle it. That will save you a lot of time and frustration. You get what you pay for. Good help isn't cheap and cheap help isn't good. If there is a crisis, take action, do something to fix it. History repeats itself. The best predictor of the future performance is past performance. Well, if you're an investor, you can already hear a couple of red flags. Let me read on. Well, guess what? Applying these principles to investing is destined to leave you poorer. As an investor, you can well be above average by settling for slightly less than the index returns. Listening to your gut is the worst thing you can do. Although it sometimes pays to hire an expert, you may get less than you pay for. Trying to fix a perceived investment crisis by taking action is usually a recipe for poorer returns, and using yesterday's results to pick tomorrow's high-performing investments or investment pros is another losing strategy. Keep it simple. Because another line from the book says, little investment knowledge, no skill, practically no time or effort, and outperforms about 80% of all investors. Of course, here he's talking about index investing. And here is why indexing is so effective. Index funds outperform approximately 80% of all actively managed funds over a long period of time. They do so for one simple reason: rock bottom costs. There are no sales commissions, operating expenses are low, many index funds are tax efficient, you don't have to hire a money manager, index funds are highly diversified and less risky, it doesn't much matter who manages the fund, style drift and tracking errors are not a problem. All of this chapter is super applicable to any EU investors. It doesn't matter where you're based, all of this knowledge can help you if you're interested in index investing. Chapter 8 is all about the cornerstone of successful investing, asset allocation. And the book then goes on to help you find a bit of a strategy on how you personally can do your asset allocation by asking 4 questions. What are your goals? What is your time frame? What is your risk tolerance? What is your personal financial situation? Then on page 105, after all the calculations and different charts and different graphs, it basically gives you a bit of a guidelines as what you can personally do depending on where in your life you're at. Chapter 9 is one of my personal favorites, and it is all about costs and how to keep costs low. Every dollar we pay in commissions, fees, expenses, and so on is $1 less that we receive from our investment. For this reason, it is critical that we keep our investment cost as low as possible. It's estimated that the total cost of all US equity markets, not just mutual funds, is about 300 billion annually. 300 billion. 300 billion. We are talking about advisory fees, brokerage commissions, customer fees, legal fees, marketing expenditures, sales, loads, securities, processing expenses, and transaction costs. Not including in the 300 billion figure is the cost of taxes, because taxes will be discussed later on. The entire philosophy of Jack Bogle and of the Bogleheads investment community is all about keeping the costs low for this very reason. And one other very interesting thing is that low cost is actually a very good predictor of a good fund. The Financial Research Corporation conducts research for industry insiders. And one of their most important studies was to determine which of 11 common predictors of future mutual fund performance really worked. The predictors studied were Morningstar ratings, past performance, expenses, turnover, manager tenure, net sales, asset size, alpha, beta, standard deviation, and the Sharpe ratio. And their study's conclusion: the expense ratio is the only reliable predictor of future mutual fund performance. How crazy. Then chapter 10 was all about taxes, and this chapter personally didn't interest me that much because it is very US based. So if you're a European investor, you can read through it, sure, but make sure that you kind of skip over some things if they're not interesting to you. Chapter 12, diversification. When it comes to investing, the old saying, don't put all your eggs in one basket, definitely applies. This is a very, very short chapter. You can basically read through it, but I didn't mark that much. Chapter 13 is also very pro ETF indexing because the title is Performance Chasing and Market Timing are hazardous to your wealth. About 75% of all mutual fund investors mistakenly use short-term past performance as their primary reason for buying a specific fund. It doesn't take a rocket scientist to figure out why. And if you flip the page, I found this little sentence which I found interesting. Index funds, by their very nature, are seldom top performance over short periods of time. More importantly, index funds are almost never bottom performers. Again, this is very applicable to any type of investor. Doesn't matter where you're from. You know, market timing is very difficult and it most of the time doesn't really make sense to do. Chapter 14 is about investing to go to college. Personally, where I'm from, that is never really an issue. College debt is very rare here, or it's at least not as crazy as it is over in the US, so I'm gonna skip this chapter. Chapter 15 is about managing windfalls successfully, and if you don't know the term windfall, it is basically when you inherit a pretty large sum of money with either like lottery winnings, inheritance, anything else. Chapter 16 then, do you need a broker? Only thing I'm gonna say is the starting quote of this chapter. I've helped put 2 children through Harvard, my broker's children. These quotes in this book are amazing. Chapter 17 is a very nice chapter. It's all about rebalancing your portfolio. The book will then talk about what is rebalancing, when you need to rebalance, why you need to rebalance, and all of this is super applicable to any type of investor. It doesn't matter where you are from. This is a very nice chapter. It is completely marked almost, so definitely read through this one with care. Chapter 18 is all about tuning out the noise because it is almost always wrong. And this is a chapter that personally I need to do way more of, so I'm gonna read through it once more after I'm done finishing this video. Whether it's newspapers, TV, radio, or the internet, all media have one primary goal: to attract and hold an audience. Chapter 19 is also one that hits right in the feels. It's all about mastering your emotions. If we can dream it, we can do it. That is the traditional American attitude of unbridled optimism and confidence. But it's not necessarily the right idea for an investment mindset. Because when we turn the page, there is this sentence: however, when it's time to make investing decisions, check your emotions at the door. This is one area of life where acting on emotional impulses will likely lead you down a path of financial wreck and ruin. The paradox of money is, while most people are very emotional about acquiring it, behaving emotionally about money is a recipe for losing it. The book then goes on to talk about ego, about fear, about overconfidence or not being confident enough. Very interesting stuff. It's all pretty base level, so it's not crazy psychological or anything, but it's definitely very good to read and mark your way through this chapter. Chapter 20 is titled Making Your Money Last Longer Than You Do. And it's kind of like a repeating chapter, like all of this you've kind of read in the book before, but it's nicely compounded into basically a refreshment. Chapter 21 is about financial insurance. Bad stuff happens to everyone. One of the best ways to prevent it from wreaking financial havoc on you or your family is by carrying the proper types and amounts of insurance. Again, insurance part is a bit more for American people, although you can definitely take a couple of nuggets of information that you then have to do some personal research on for your own case. There's also these 3 rules about being properly insured. Only insure against the big catastrophes and disasters that you can't afford to pay for out of pocket. The cheapest insurance is self-insurance. Carry the largest possible deductibles you can afford. The larger the deductible, the more you are self-insuring and the cheaper the premium will be. Only buy coverage from the best rated insurance companies. You need insurance companies you can depend on when you need to file a claim. So all of this is applicable to each and every one. It's a bit surface level, but it holds true in my book. Chapter 22 is titled Passing It On When You Pass On, and it's of course about leaving an inheritance for your children. And it starts off with a very funny sentence: even though you may not feel rich, the tax collector may disagree with you. For me personally, it's a bit too far away. Again, I'm only 24, but if you're a bit further on in life and maybe you already have children, this might be a good chapter to read through. I personally didn't mark a whole lot, so I'm not entirely sure if it's all applicable for EU investors like myself or wherever you're from. So not sure about this one. Let's go on to the next. And that is the final chapter, chapter 23. You can do it. The only thing I really want to say in this chapter is that I personally am also into the subreddit of Bogleheads, which is a very nice subreddit. It's kind of similar to ETFs in a way, but definitely check it out if you are on Reddit. So that's it. That was the entirety of the Bogleheads Guide to Investing. Now, the big question is this a good book? Yes. Is this a good book if you are not based in the US? Yes. Will you get a lot of information out of it that is also applicable to you? Yes, again. Is every single page applicable to you? No, of course not. Definitely pick it up. It's a very good mindset to have. It's nice to just mark things down, flick through every now and again, and I learned a lot of things when reading through this book. You can find it in the description down below by using a link. It's not sponsored or anything, it's just a regular affiliate link. So if you enjoyed this content and if you want to support me a little bit and buy the book and support yourself in that way, you can use the link down in the description below. So if this video does well and you're happy to see it, let me know which one of these you'd like me to review next. And if you enjoyed this video, be sure to leave a like, subscribe for plenty more videos to come, and I will see you in the next one. Ciao.